Welcome back to Morning Trade Live. Time now to focus in on the macro picture. Joining us now for insight is Michael Shaoul, Chairman, CEO, and Portfolio Manager, Market Field Asset Management. Thanks so much for joining us this morning. Let's dive into kind of setting the stage, your take, big picture here on where we stand. We had PCE out last week. We've got Powell heading for congressional testimony, semi-annual testimony later this week. What's the big picture of where things stand from your point of view on the macro?
I mean, in a nutshell, the US economy looks to be strengthening, not weakening, with the Fed at 5.5%. I think the FOMC is emotionally committed to cutting interest rates whenever possible. But that looks to me to be a policy mistake. There's nothing in the bulk of the economic data that you look at that suggests it's a good idea to cut. As far as inflation's concerned, it's come down very rapidly to around 3%, depending on which measures we're looking at. But it's obviously well embedded in the service sector. In the service sector, it's running much hotter than 3%. And if you start to see, goods inflation bottom and start to rebound in the middle of this year, well, you're going to have headline numbers and core numbers at, I think, uncomfortably high levels. So, it's a good economy. It's a good equity market. The Fed, to my mind, should be sticking at 5.5%, but they want to cut, and maybe they will.
So, but why do you say it's a policy mistake? Eventually they'll have to. Obviously, the odds are that it's not going to happen in March and possibly not even in May. Why would you say it's a policy mistake, say, I don't know, later this year?
Well, I think asset markets are telling you that the response to any cut is going to be more sort of speculative fever. And, it's a long time ago, the late 1990s, for those of us who remember what happened in the US in the late 1990s or Japan in the late 1980s, understand that in these sorts of situations, monetary policy, which is too loose, encourages the kind of speculative behavior that in the end leads to a very problematic bust. And I think the Fed has been silent about asset markets in recent months. The only time they talked about asset markets was in the sort of November period of last year, when they welcomed interest rates, long-term interest rates going up to 5% as an imposition of tightening on the economy. I think right now, any kind of rate cut between now and June looks to be a clear policy mistake, and the sort of policy mistake which will lead to the Fed losing whatever control it still has, if it has any, over asset markets.
So is your concern that we're headed to kind of a stagflation scenario?
No. My concern is that they are simply losing control of financial markets. You've got the S&P above 5,100. You've got gold at an all-time high. You've even got the Nikkei at an all-time high. This is starting to look like the sort of environment that monetary policy is encouraging, the chasing of all financial assets. And historically, those have been very problematic in their aftermath. So, as I say, there's no obvious economic reason to cut rates. They shouldn't even be talking about cutting rates. But, it's a committee, and committees get committed to certain ideas. That's the sort of world in which we live in right now.
Well, the Fed consistently talks about its 2% target. And then when you look at, say, core PCE, we know that this is the Fed's preferred inflation gauge. It's getting closer to that. Is that not a metric that you think the Fed should be? I mean, what are the main metrics that you're thinking the Fed should consider outside of that?
I mean, I'm fine with them keeping that metric, but there's really nothing in the PCE report that suggests you're actually going to get to 2% and stay there. What you had was a lot of goods inflation, which turned into moderate goods deflation. But the service sector really has not cooled as far as inflation is concerned. And as I say, there are signs that the destocking cycle in the manufacturing sector is ending. And at the very least, you're going to have sideways goods prices to moderately up goods prices with sticky service inflation And so, it seems very unlikely when I look at the data that you're going to get either PCE or CPI or the GDP deflator, whatever you really want to use. But there's nothing out there that looks like it's going to get to 2% and stay there. This is not the kind of economy that we had between the financial crisis and COVID, that long decade plus period, which had decent economic growth and very, very low inflation, has been changed into an environment with much higher nominal growth and inflation attached to that. In fact, again, something that looked much more like the 1990s. It's not stagflation, but it is the sort of environment that central banks can lose control. And that is, of course, what happened to the Greenspan Fed between 1998 and 2000. They woefully underestimated the speculative impulse. We dealt with a very difficult period between 2000 and 2003.
And so let me ask you, well, there was the dot-com bubble that happened at that time. So are you suggesting there's a bubble somewhere?
I'm suggesting that all financial markets, pretty much anything you look at is telling you the Fed is too loose. As I say, global indexes are breaking out to all-time high. Things like gold, which are really the purest measure of monetary policy, which relative strength or tightness, hit an all-time high on Friday with almost no commentary and almost no flows towards it. I think if they cut rates, you're going to have what happened in 98, 99. You're going to have a mad chase into risk assets, which will develop into some form of bubble. I'm not sure I would call the S&P a bubble yet. We've had a few mini bubbles. We had one in 2021 with probably a sort of mini bubble around AI right now. As I say, the behavior that the Fed is suggesting makes sense as far as the economy is concerned. Really, to me, looks like taking a wholly unnecessary risk within financial markets and financial market governance.
So to tease that out a little bit further, where you say a wholly unnecessary risk, and where you think about where many of these asset classes are, how should investors be bracing themselves for, say, the potential of your scenario coming to pass?
I think investors have embraced risk assets, and they've been right to do so. As I say, I think the one thing that I look at that people have been selling that they should have been buying, I think, is gold. Gold ETF ownership is down it's at a 4-year low right now. So I think that's something people could put into their portfolios as a substitute for fixed income. But one thing I would be avoiding is long duration, high quality fixed income. That to me looks like a poor place to be. But I think the Fed is already too loose versus economic activity, and if they cut, that'll be even more the case.
And then I want to ask you, we've got the job market in focus this week. We've got a big jobs report at the end of the week, a couple other job reports as well with ADP, JOLTS, et cetera. What are you looking for from that jobs report come Friday?
Realistically, January's report was too strong. So we're probably due either in February or March a poor report. This data does zigzag. But again, overall, the labor market looks just fine. We're certainly at full employment. There's certainly been no obvious deterioration of employment in any of the major sectors. It takes a long time for the labor market to deteriorate, and we haven't yet started to see that process. So, as I say, it wouldn't shock me if we have a poor job report on Friday, only because of the I think unrealistically strong report that we saw in January. But if you sort of average things out, January, February, March, I think the labor market's going to look pretty much like it looked in October, November, December last year. In other words, there's no obvious indication of any deterioration in the labor market. And again, with regards to monetary policy, there's absolutely nothing in the labor market data that suggests the Fed needs to be thinking about cutting rates.
And speaking of the Fed, what are you looking to hear from Fed Chair Jay Powell when he speaks before Congress this week?
I don't think he's going to be under tremendous pressure. I think Congress is happy enough. I think he's going to try and keep his options open. I think there's going to be a lot of sort of nonsense talked about the Fed's role in income equality because that's become a big issue out there. But so there's nothing that monetary policy could really do. I don't think it's one of those times that we're going to learn. We're going to learn a lot. As I say, it's a relatively easy time to be the Fed chair because inflation's behaving itself and the labor market's behaving itself. And the equity market is not yet obviously in a bubble. It's going to get harder as this year goes on. But I'm not, I'm not really looking forward to that testimony and expecting to hear anything that's going to make any significant change to the sort of medium-term view. He might say something that moves the needle in the market for a day, but I don't really care about that.
Okay, all right. Well, we know he does like to keep his options open, and
Yes.
we consistently hear the theme of this is a data-dependent Fed. All right, thank you so much for joining us this morning. That's Michael
Thank you.
Shaoul, Chairman, CEO, and Portfolio Manager. You got it, Market Field Asset Management.